Hi, Nomi here, and I'm reaching out to share some brief Prinsights as this turbulent financial market behavior develops. First and foremost, this market response is a multifaceted one. From the Federal Reserve's policy stance, Japanese market turmoil, war in the Middle East, slumping employment data in the United States, and more, these volatility signals are very widespread. However, at least for the markets, the most significant factor is the Federal Reserve. Last Wednesday, Fed Chairman Jerome Powell signaled that the Fed was not seeing as much inflation reduction or economic weakness as it was hoping for. The issue is that the unemployment rate has in fact been rising steadily over the past 5 months to 4.3% last Friday, and wage growth is dropping. So, what is going on? Investors are dumping risk or preserving capital now with the idea of figuring out what's going on later. And then program trading exacerbates this market response. The bottom line is that the US consumer is struggling, and many areas of the United States economy are experiencing rising unemployment rates and contracting economic conditions. We're seeing this actually in many places around the world. Investors, though, are spooked by where the Fed might land. So they're taking chips off the table or moving them to safer investment strategies or holding them in cash. Now, because the Olympics are underway, we're going to use a relay analogy to illustrate what's happening. The volatility baton is being passed from the Fed, which is trying to understand whether inflation levels have lowered enough for a rate cut, to market participants who are trying to understand if, when, and by how much the Fed might act, and if they have waited too long. So, what should you do in the meantime? In the near term, you should watch for three main data points ahead of the Fed's next policy decision on September 18th. First, we're going to get a new inflation report on August 14th, followed by another jobs report on September 6th, and another CPI report on September 11th. I forecast that the Fed is going to respond with a rate cut. The question over whether it will be 25 or 50 basis points should be clarified based on the reading on September 6th. Regardless of what happens, though, the Fed has definitely dropped the baton, and it is way behind the curve. Only last week, Powell was hinting at the possibility of no cuts at all. Now, the question on Wall Street has shifted from not if, but by how much the Fed might cut rates. So, what should those involved in the markets be doing? First, please stay calm. The sky isn't falling, but volatility is here to stay until the Fed acts more decisively. If you're looking to dip into the markets now, consider legging into the broad S&P 500 index ETF, or ticker SPY. Historically, once Fed uncertainty clears, we do see upward trends develop despite scary volatility periods. Legging or averaging into investments is a way to avoid trying to pick a bottom or investing too much at any one time during chop. It's just a calmer approach to the markets. As always, knowing is growing. And thank you so much for tuning in.